Fulfillment Key. Today we're going to be going over the dividend income and closed-end funds report for week 1 as of November 22nd, 2020. So without any further ado, let's get straight into it and see what we have for the week. So diving into our top positions, we're up about 4.72% on the year with an average of an 8.51% yield. Now, that was the yield as of investment was about 9.7%, but the yield just continues to go up as the principal continues to go up. So that's why if you guys ever see the positions and the yield changing, then you'll know why. So our top 3 positions are PTY, which were up 8.35%, about a 2,600 profit on a cost basis of about 31,000. CHW, where we're up 11.67% and a $1,700 profit. RQI, we're up about 7.5% with a $1,400 profit, and PDI, we're up about 4.5% with a $1,200 profit. Guys, remember to like, comment, and subscribe. Got to throw it in there, but I'd love to interact with you guys. But on to the first position, we're with PTY, which is the Pimco Corporate Opportunity Fund, which is basically a bunch of corporate debt from some of the junk bonds that are highly rated by the credit rating agencies. And there is still remaining upside for this. In fact, this is one of my most confident positions. In fact, if you look at the 5-year price history, there's still about a couple of dollars left to where we can continue to reach that upside. But I will say, though, reach it with caution, because a lot of the dips that you're seeing are perfect opportunities to buy, but there's still a chance that there could be bad vaccine news or anything bad like that, and then that would result in a lot of these funds, since they're kind of a replication, or they're kind of a reflection of what's going on in the market with like a lesser volatility, they will reflect that. So keep that in mind, and there's still some upside. Currently we're about 1705 current price, but we could make it up to 1950 or the 2018 high of 1850, which is still good because it's like 10% upside with almost a 10% yield. If you're looking at the technicals over here, the moving averages say it's a strong buy, and the summary is about 13 buy signals, 2 sell signals, and 9 neutral, which are not going in either direction. I tend to stay away from a lot of this technical stuff. When the ones I usually follow closely are moving averages, which as you can see, there's a strong buy, and the RSI is 52.52. So that's not overbought, but we're getting there. Like I said, you can still open a position, but I'd recommend being wise. And as you can see here, I like to put kind of the history so that you guys can see. I talked about this a little bit in the last video, but I think that showing the history is a really good way to kind of solidify the fact that it's been unchanged throughout this entire pandemic situation. As you can see, there's only one time where they dropped it to about 7 cents, which was in like 2018, which is not even related to the pandemic. But on to the next. This is Calamos Global Dynamic Income. This is tech debt. I actually really like this fund, and people give me a lot of shit for it. A lot of people that I'm in this investment group with a couple of friends, and they give me a lot of shit for it because they're like, if you're in tech debt, why don't you just buy into tech? Like being me, it's like, I get it. And I am actually opening up a growth portfolio, which I'm going to, put about 5% in. But that's besides the point. This has tech debt, which a lot of people are confident in tech companies, which is a plus because, you're looking at the likes of Microsoft, Taiwan Semiconductor, Alphabet, just to name a few that are, that have debt held by Calamos, which is great. So if you can look over here, we're up about 11.67%, and the yield is 9.25%, which, if we combine that together annually, thus far is about a 20.92% return, which, doesn't beat out the S&P, which, the S&P, since it includes a lot of the, with Tesla being included and stocks, but, that's besides the point. It doesn't beat it, but on the average 8% return over the last 100 years, it does beat it. So that's just that. And you get that liquid cash flow, you can pull it out at any time. It's not like something where you would be like, oh shoot, like it's dipped and I really can't pull out. Oh, well, if your principal dips, you're good. So, but back to CHW, it's basically where it was at the end of 2019 before all this news hit. So I think that, I would stay away from it right now, but it is still a solid fund with solid returns and, solid distributions. Like it's really good. So I think, I'd love to get you guys' opinion, but I think that, it's still, going into Monday and Tuesday, there may be some situations where there could be good opportunities to get into it. So, like I said, little opportunity. And I like to look at technicals. Like I said, I didn't use the technicals for this one so much because, they're kind of all over the place. It was generally a buy for this, but the RSI is 58.18. So it's not overbought, but, we're getting to that 70, 80 point where when stuff gets there, I start to, pull back a little bit, or I'll pull profits just because, it's an indicator that something could happen. So, just be wise and wait for an opportunity with this one. Like I said, once you get the opportunity, you get in, and you get in at the right price. You can just sit there and collect those checks. So on to the next, we're looking at RQI, which is Cohen and Steers Realty Fund. It's a lot of real estate investment companies that I'm not too sure if they hold stocks and they do some sort of covered call situation, or if they hold notes, but I'm pretty sure they hold notes. So there's still some upside to this. If you can look at the chart for the 5 years, like I have it, up on the screen right here. November 20th, which was market close on Friday, was about $12. So, there's still a lot of arbitrage that can be done there if you're someone who's trying to flip the ex-dividend dates, or if you're someone like me who wants to, hold long-term. I would suggest this one because this one over the last 10 years has just annihilated the S&P. I think if you had bought in at 2010 and you held till like January 2020, you would have been up like $10,000 into $63,000. I'll have to put that somewhere, but or put that in the group. But that is insane. But back to this, we're up about 7.5%, and the yield is 8%. Like I said, I don't touch anything if it's not monthly. But the combined annual return is about 15.5%, which is good. People are like, oh, you can get more with tech, which I highly encourage you guys to do tech and growth, and I'm going to do more, situations with those going forward. But as of now, we're trying to reach consistent income so that we can have the other stuff, we can have that consistent income going into tech and other risky positions, because we're playing not with the principal, but with what comes out of the principal. You see what I'm saying? But yeah, this is currently a high price. That's relative, because looking at this chart, it's at average. If you look at it, you just draw a straight line across, and you look at the supports. I would still scoop up some. I still have my drip turned on this, so I would still pick up some. But, I would say hold more cash, because if you can get in at a good cost basis on this, like where I got in around, it would still be a really good position. So, like I said, there's that. And the RSI is about 62.48. It's nearing overbought levels. It's still not at that point where I would say just stay away from it completely, but it's getting to that point. And sometimes technicals don't tell the whole story, which is something I think people should really look at. But math, so look at the technicals and try to understand what's going on. But yeah, approach with caution is what I would say. But if you see an opportunity, fucking take that shit. So and the fourth, these are all the things that I covered a couple of weeks back, but this is PDI, which is Cohen and Steers. Oh, it's not Cohen and Steers, actually. It is Pimco Dynamic Income. I'm so sorry that I didn't change that, but I probably should have. But there's still a lot of upside with this. If you look at the chart, it's really strong. We've got a market capitalization of about 1.69 billion. Great. And it's got strong price history, which I think is really a good indicator. So, and with a 10% yield, that if there's strong price history and a 10% yield, you can lock in that yield at a lower rate, and flip out at 2021, 2022 once this whole thing blows over, and you'll have a 22% upside remaining. If it doesn't even go above that, because I think people are going to be chasing fixed income after the tech bubble bursts around 2022, if it does. But there's a lot of people saying that, talking in everyone's ear, saying stuff. But anyway, 10.28%. Paid monthly, annual return of 14.78% as of current. It's currently at around average price. In fact, I would say it's below average price if you look at, since 2010. So I would totally, I have my drip on right now. I'm just continuously just buying more shares with whatever I'm getting. And there's still upside remaining. It's currently at 25.73. It can make it up to 33. if not more, like I said, with the whole fixed income situation, is a lot of people that are nearing retirement, the boomers, they're trying to move into fixed income because a lot of them, I mean, some of them are still following that 3% rule, but let's be honest, I don't think that's really applicable a lot. And a lot of, Wall Street people are chasing fixed income too, and they're starting these new opportunities. I think one of the new funds that came out is called JetB. I'll go over that in another video, but yeah, RSI 65.48, getting to 70. It's that point where, I would say stay away from it. But, still a good opportunity. Like I said, technicals don't always tell the story. So, just know that. So, like I say in every video, and if you've been in any of our group calls, even in anything, the key to getting wealthy is to get started. You got to grind, invest, and repeat. So what I tell everybody in our group, what I tell everybody in the videos is just you set aside a certain amount every month, and you should let it go. And I think a common quote that someone actually sent to me earlier was, and I wanted to put it in the video because I think it was dope, but you'll overestimate what you can do in 5 years and underestimate what you can do in 10. So I found that super awesome. And I got some new plays for you guys. So they're risky, but they could be rewarding. Could be, and the reward just outweighs the risk by a lot. And I wouldn't actually say risky. I would say the first two I'm going to show you are on the conservative side of risky, but I mean, it depends on how you want to play. But let's get into them. So these two are dope funds by Cornerstone. They're medium risk because, as you can see, the history over the last 5 years, they've just been consistently losing value. And I'm going to talk about that in a second. And the reason they do lose value like that is because it's basically eating away at your initial investment. So the way these funds work is they're basically just paying you back what you invested in it, plus the income. So they do what's called return of capital, which is a lot of closed-end funds like to use, but they kind of eat away the original, whatever you invested and give it back to you, because sometimes it means that, a fund is not making profit. But in this case, it's different because their fund is just engineered in a way to do that. So, I kind of saw this at first, and I looked at the chart in 2008 and I was like, it lost so much value. But now that I see it at this point, I think it's a perfect time to, to get back in, because I was testing this and I had it on my watch list for a very long time because I had seen it drop in March. And in fact, in March, I was still skeptical it was going to go down lower. We all beat ourselves up for not getting in then, or getting in too little at that point. So, but yeah, so seeing that it recovered to the point it was at before, it showed me, okay, so there's some price strength here, it is good. So I would still, go for this. And it's on a long-term bear trend, so I would say this is like a 5-year play. And you pull out after 5 years, or you can keep it in. But you might want to see, because there's usually some weird shit that happens with the American stock market every 10 years or every 7 to 8 years, or there's a little weird bounce. And if you really need the money, you got to pull out, but I would recommend against it. So CLM, 20.05% yield. But that's with an asterisk. And why I say that is because, it's essentially really a 15 to 16% yield, because you have to assume, based on studying the history of the price action, that there's going to be about a 5% loss on principal each year. If we estimate that from, back in 2015. So accounting for that, let's say we take the 5%, out of the 20 and then reinvest that to make up for the principal loss. That is how you'll keep your principal afloat and keep your principal at where it was when you started. So essentially, you're going to be losing that 5%, but you're going to be collecting 15 to 16% a year, if that makes sense. That is for CLM, and CRF is a little bit less. It's kind of like a mirrored. I think they're kind of like the same thing, just like different versions. Kind of how there's like stocks. There's a stock A, stock B, Alphabet has stock A, stock B, kind of like that. But they're essentially really a 14 to 15% yield, like I said, because this one has, doing the math, has lost a bit more. So I'd assume 5.5% loss on principal each year. And you just take that and put it, keep putting it back in order to keep your principal afloat and keep it where it was in the past. And that's assuming that it continues falling. If it doesn't, then you're just getting 20%, which is 5 years, double your money. So, it's great. Like I said, medium risk. This is not super high risk, but it is medium risk. And, you guys should always do your own research. I'm not a financial advisor. I just do a lot of research. But, And the next play we're going to get into is Oxford Square Capital. High risk play, like I said. I was actually in this before this whole pandemic mess came through. And it was actually interesting because it was actually doing really good, and I was collecting a lot of good like dividends from them. And luckily I did get out because I sold a lot of my stock in January just because I wanted to. That worked out perfectly. But it's a 14.7% dividend yield. It's paid monthly. Like I said, over here we like monthly cash flow, and we like high returns, not super fast, but in a relatively short time span of 5-6 years. This stock has beat their earnings per share, which was something I was waiting for. Once that Q3 report came out, I was like, okay, this is good, because I wanted to see what's going on with them, because I have a position as well, and I've seen that following that there was kind of an uptick. It started to go from 230 to 285, so I think there's some upwards price movement. And I studied the history in the price action, and in 2008, when it did crash due to the financial crisis, it was able to recover, not to the levels it was at before, but it still recovered a decent amount. So I think that that's something to keep in mind, that it might have taken a large hit, but it can still come back. And when it does, it's going to come back strong. So even if it goes back to $6 or $7 where it was at before, that's like 200% practically. So keep that in mind. Good dividend history. But like I said, it's still like this uptick is due to earnings. A lot of people play earnings. I'm not one of those guys. I don't like to stay glued to screens. I just like to get in plays and get out in a couple weeks, take a look every day in the morning, brush my teeth, whatever. But like I say with all the other ones, try to buy on a dip. Otherwise, take a small position and continue to accumulate despite what's happening with the stock, if you guys want to run this play. And keep in mind that within 1 to 2 years, if you are up 200%, I would get out. Because, if it's dipped this much, it's kind of really volatile play, and you don't want to lose those gains overnight because of, because you're chasing yields, basically. But, yeah, that is all of the new plays that I have for this week, and that is all of the positions that I wanted to review this week. This is the current portfolio income that I wanted to share with you guys, just showing you guys the progress that we're making and how you guys can make progress as well. So you guys can see everything's on the screen. If you guys are in the group, I will put a long list of all the positions that I'm in, and you guys will be able to see everything. I think it'll be dope. Once this number hits 3,000, we're going to do something special. But until then, that is it for this video. If you guys have any questions, you guys want to ask about the group, you guys want to know anything, just hit me up, comment, like, subscribe, and remember that it helps. And remember, I'm trying to build the best community for investing in dividend stocks. I don't know why I tripped up there, but yeah, if you guys are one of us, feel free to join. That's all I have to say. Hope you guys have a good one and get ready for market open. Peace.